Good afternoon, ladies and gentlemen. My name's Bill Thornhill. I'm the editor of Covered Bonds at Global Capital. I'm glad you've joined us for the post-pandemic credit risks from sovereigns to shops panel. And I'd like you to introduce my colleagues, starting off with Helene.
Yes, thank you, Bill. So I'm Hélène Heberlein. I'm in charge of cover bond ratings at Fit Ratings. We rate above 100 programs, mostly in Europe, but also in Canada and LATAM and in APAC.
Georg.
I'm Georg Grodzki, a member of the investment team of Alter Marchem, which is a provider of alternative asset platforms, and I've been a lifelong fan and supporter of covered bonds, previously in roles in credit research, but nonetheless only a stone's throw away from liquid bond markets at the moment.
And finally, the man who probably needs no introduction at all, Richard.
Well, you've just stole my line about a lifelong supporter of covered bonds. So I'm an independent consultant doing anything to do with covered bonds, really, but a lot of my time working on the development of covered bonds in developing markets in Central and Eastern Europe and beyond.
Thank you, Richard. And we would encourage lots of participation in this discussion. So if you have any questions, please do type them into your chat boxes and let us know, and we'll fill them out to whoever feels able to reply. And we'll kick off with the first question to Helene. We're going to be talking about mortgage payment holidays. Helene, in your opinion, do you think they worked?
Yes, I think they did, Bill. So payment holidays, I think they kind of created a lot of anxiety in this market last year when they first started. And in fact, they were a response to the crisis, which made plenty of sense. It started in Italy, where in fact it had been utilized as a response to other crises, more like natural causes, earthquakes, these types of things. But yes, it was widely adopted in almost all countries we cover, and yes, as I said, a lot of anxiety from market participants about the impact, but in reality, they did help borrower, facing their kind of making their life going on and not worrying about their mortgage for a little while, and I don't think they've had negative consequences that we can see as of now. So for cover bonds in particular, there was no direct impact on payment because payments are coming from the issuer regardless. So as long as the issuer is solvent, the payment holidays were not having a direct impact on cover bond ratings and cover bond payment, in fact. And by now they have receded. So I think a lot of that question mark has gone out, really.
Yeah. On the other hand, there was a kind of a big concern to begin with that given the past that we'd seen in the global financial crisis, that some of these payment holidays tended to be more risky in the long run. I mean that doesn't seem to have transpired so far. But in general, maybe Georg, payment holidays, they're not really that good for the lender or the note holder, are they?
Well, I'm a bit old school here, and I do remember principles such as the sanctity of contracts and the property rights of asset owners, and therefore, from a very fundamental viewpoint, governments interfering with private contracts is quite a big event and shouldn't be belittled. The motives may have been very laudable, and I've no doubt they were. But we just have to acknowledge that it's part of this very subtle creeping regime change, which we've seen over the last 15 years, with governments interfering a lot more than they used to, and becoming intervention happy on the grounds that there is popular demand for something, and in fact there is popular support for that as well, like a government legislated default, which is painless because it doesn't result in the usual consequences. So it's a slightly uncomfortable development, and whilst it eases some of the pain from external shocks, and we have to acknowledge there was an external shock, no question, it can be abused, and it has been abused in the past. And we all know which cases I'm referring to here. Governments may find it convenient to expropriate lenders, even if only temporarily, in order to win popular support. And I think there is an element of danger in this, despite the benefits from a social welfare perspective.
And in a similar vein, I think, you know, from maybe you could argue that they've created some sort of precedent. I mean, we as Helene said earlier on, they started off in Italy, but now it's gone global. And once you've done it once, it's going to be so much easier to do it again, Richard. Do you
Well,
not think?
you could go back further. I mean, I remember in Hungary when the government intervened in order to basically bail out the borrowers of foreign currency mortgages who were hit by adverse exchange rate movements, and they made the banks pay for the consequences. And therefore there are even earlier precedences. Sorry, Bill, for saying that. And the list is getting longer, and as you said, it's becoming a bit habitual, and I see that with some reservation and concern.
Well, every time it happens, it becomes easier to do it next time. And I think that, yeah, I understand it. The government saying you can't earn, then the government has to give you something in return rather than the bank repossess your house. But that creates a very dangerous precedent for, particularly when you look at political changes, changes in the overall balance between the lenders and the borrowers, society. It creates a really dangerous precedent. We see it for systemic problems. Are we going to start seeing it for more and more categories of idiosyncratic? Individual borrower falls on hard times for whatever, a general willingness for more debt forgiveness, for more suspension of payments. You know, that is a dangerous precedent, and I don't want to sound heartless about it, but let's look at how banks are going to start changing their behaviour as a consequence of that. They are going to stop lending in certain circumstances. They are going to start denying access to credit. People are going to be less willing to supply money to the banks because they're viewed as being such political pariahs and the first one to get sacrificed in response to some kind of societal need.
Mm.
I
mean,
think if it's a bit exaggerated, right, Richard, it was not really a free gift, not for the lender, not for the borrowers. Sometimes it was just postponing, you know, so it's called payment holiday. It's not called, you know, never pay again your mortgage. So it's a temporary thing. Often it was coupled with a lengthening of the term or a reduction in installment in exchange for a lengthening of the term. So I don't think lenders have lost. You know, anything, and on the contrary, it prevented you know, a spiraling of effect, whereby if you are foreclosing en masse, you know, against people who are facing a temporary shock, it's not the best solution to get you know, the value back at the end of the loan. So I think it was yes, it was global, which was a bit unheard of. Also, I would say one of the detriment of this, and maybe next time if it does happen, which I hopefully not, but we could discuss this. There was a lot of disclosure on this, right? So among all the programs we rate, very few, maybe 20% or so, communicated publicly on the level in the pool. Also because it was sudden, right? So sometimes the IT systems of banks are not the quickest to respond. And also the other thing, which was a bit, it didn't. There was not a lot of clarity in total, also because the banking authorities allowed for those payment holidays to not count as arrears, right? So they were not. It was a bit of it was a bit masking the real, and I think that's what, you know, market participants were worried about, is that you could not really distinguish anymore if it was not really reported as problematic loans. So I think that may be something which you know, it was not the best.
Don't get me wrong, it was necessary, but I think a lot of people confuse the point about payment holiday and payment forgiveness. If you've got a 25-year mortgage and it's now become a 26-year mortgage, you don't really notice that. If I haven't had to make monthly payments on my mortgage for a month, I'm going to change my behaviour because of that, and we have seen examples of that. It was absolutely necessary. My point is, now that we've created that precedent, what next? where does it get applied next?
Mm.
Be my concern.
I mean, going back to what Helene said, you mentioned she mentioned that only 20% of the issuers had disclosed how many people were on payment holidays. 20% of the people had only disclosed how many were on payment holidays. That means 80%, presumably, Helene, had not disclosed that amount.
Not publicly to us, yes. So
They
yeah, it was.
Okay, so they disclosed it to you, but not publicly.
Yeah, I think it was. There was some initiative to have it public, to have public disclosure. The harmonized transparency template had a voluntary, worksheet for that. But yes, there was not a lot of standardization on this, and again, a bit of more transparency would have been would have helped, I suppose. Kind of reassuring people on what's going on.
And
Georg,
nonetheless,
yeah.
it is about the government dipping into other people's pockets, in this case, the mortgage lenders, in order to basically carry out a social policy initiative. They could have provided more furlough money or direct subsidies to mortgage borrowers in order to help them over this difficult period. But they decided it's more convenient and certainly cheaper for the taxpayer if they just mandate the lenders to step up to the plate.
No,
And
they
and to
have,
pay for
Georg,
that.
right? All of the support schemes for job
I know,
retention,
but they could have,
self-employed income
they,
compensation. So
sure,
that has happened at the same time, and it is ongoing for some countries at least. And so, to me, this is what is having a larger impact on on the safety of the asset classes, because the the level of arrears is a lot lower than we would have expected at the start of the pandemic, because of these support measures, more than due to the
well,
payment holidays, in fact.
you could call it window dressing asset quality.
Yeah, I mean,
Temporarily.
It's a
I guess
much
the
bigger
biggest, I was going to say, I guess the biggest problem really is that investors are kind of in the dark if they have no idea. You know, if under different circumstances, we see a prolonged lockdown continuing maybe into next year, for example. Who knows? God forbid, but who knows? And potentially more payment holidays coming down. I think it would be right for investors to know what the proportion is, and it's that lack of disclosure which is probably the most worrying thing. George, do you think that central banks have lost their inner sense? Do you think they've become subservient to their
Well,
political masters?
the case can be made already, but the proof will probably transpire, or the truth will transpire in the next 12 months. We had US CPI numbers yesterday, slightly better than expected. We had headline CPIs from the UK this morning, worse than expected, for reasons which are understandable. But central banks have become, at least on the surface, very complacent about the latent inflation, which has now become less latent and quite apparent. And that is the proof of the pudding. Central banks, yes, to the extent possible, are required or expected to support the policy mandate or the policy task of the respective elected governments. But the reason why they exist is that they control money supply in a way that is fair, is helpful to the economy, allows for efficient allocation of capital, and of course prevents the erosion of the value of money through inflation. I think that goal should not be forgotten. And a venerable institution like the Bundesbank, which has a very good record in controlling inflation, would not tire to emphasize that there are important social reasons to keep inflation in check, because inflation hits the less well off much harder than the better off. So, but with after 15 years of money printing, or 14 years, and monetization of public debt, and given the debt load, recently increased debt load of governments due to COVID, Central banks, of course, find it politically very hard, and there's plenty of evidence for that. Just remember the spat between Powell and Trump last year. Politically very hard to act in the name of protecting savers from the time value of money being eroded, but also the value of money being eroded, because can they really risk governments and other borrowers being landed with a normalization of interest rates, which would cripple many of these borrowers because they have become addicted to these artificially low interest rates. So they have planted themselves in a corner. And yes, we know how they got there. The intentions were all very laudable, but they have lost their innocence, and they're now not even formally, look at the UK, any longer independent. And factually, I think they are definitely no longer independent, and the ECB, of course, has to watch very carefully what the sovereign indebtedness and sovereign solvency implications of a potential tapering exercise would be, leave alone a rise in interest rates.
Just
I don't think. Sorry, I've got to on the point about inflation. I genuinely don't think that central banks are even trying to be independent on that point anymore. I think that, fundamentally, like the payment holidays, it comes back to somebody paying for everything that's happened, all of these furloughs, all of these payment holidays. We've seen vast increases, in particular in sovereign debt, but also implicitly in consumer debt by the payment holidays. Inflation isn't a bug, it's a feature. And arguably, over the last few years, when we should have been having fiscal stimulus in many countries, we've had to rely on more and more extreme cases of monetary stimulus. Why are they independent? The only control over the Eurozone economy, over many economies, has been monetary policy. Is it right that that's not politically accountable anymore? Everyone always goes on about central bank independence. Now, monetary policy has hit its limits. We're now in the stage where we have a temporary relax of fiscal rules. Inflation is the only way to address that debt.
Monetary policy was always limited. You can't make people spend money no matter how low the interest rate is, and it could be argued, and I think it is being argued in academic circles and elsewhere, that it is a woefully inefficient instrument to stimulate growth on the economy, because it just provides the preconditions for borrowing and spending, but it cannot make people spend if there is no confidence or if there are no sensible investment opportunities. That kind of asymmetry of monetary policy always was there. And you said there should have been fiscal stimulus. Well, I think there was quite a bit of fiscal stimulus, and it achieved some effect. But monetary policy was always, I think, was structurally overestimated in its ability to boost the economy. And I think it should have been always looked at with a more realistic view that you can print any amount of money, but if the willingness to spend isn't there, it won't have any lasting effect. And last point is on this is it resulted in this massive asset price inflation, which of course on paper provides a comfort blanket also for covered bond holders and mortgage lenders, because it has helped to drive up house prices, but it massively increased social divides, and I don't know yet what the wider ranging implications politically as well of that deepening gap in the society will be between asset owners and asset borrowers.
Elaine, any thoughts about the asset price inflation bubble that we're seeing in house prices? I mean, there are two sides to it, right?
Yep. No, so you're right. The house price have risen faster than we were predicting. We revised our house price growth forecast upwards for countries. I mean, some of them double digit by now. Australia, Canada, Denmark. So prices are forecast to rise by 10% or more. Well, the reasons are not just monetary policy. Obviously, it's low rates are one reason, but not only. I think it's also the consequence of the pandemic. you know, when we have accumulated collectively, apparently, a lot of savings through lockdowns and closure of borders, working from home, we just spend less, so we save more. We have more money to spend on houses, and also the recovery has been stronger. So the you know the that I think that is also supporting house price. So in some markets, we think prices are overvalued, and that brings the risk of simply a risk of a crash. You don't know when. You just know that the more overvalued the properties are, the less safe you feel for the future. So that's why, and in fact, in some markets, rates are starting to rise. In Korea, for instance, we've seen this, and banking authorities are trying to, you know, put rules in place to avoid excessive lendings, to avoid damage to the economy. So rules on affordability in France, in Canada, we see this, banking authorities are trying to prevent the next crisis in a way, right? So,
Yeah,
so
yeah,
that's the downside of rising house prices.
yeah.
Uh,
If we get high and persistent inflation, I mean, are central banks going to react to that, or are they always going to be behind the curve? And if they do react to that, then presumably that puts up mortgage payment costs and the bubble is burst at some point. Anyone want to comment on that? It's never happened in the last, 30 years, is it? We've been on a rising trend pretty much. I can remember the last house price crash in London was 1990 or something.
No, but later. Really, the lowest point was 93, roughly speaking, and it was a painful period, and evictions were running very high, unthinkable these days. But there we had a bubble bursting, and that was not just the UK; it was Scandinavia as well, and so
It's not really in living memory, is it? I mean, 25 years is the generation, so most people it's not on their radar screen, not even
absolutely.
policymakers.
Absolutely. Um, and those who do remember, of course, would rather forget that memory because it wasn't a pleasant one. Coming back to the point, inflation it depends on what kind of inflation it is. At the moment, what we do see is wages going up, and that's of course good for net disposable incomes and should support asset quality. But if it translates into a wage price spiral, there won't be much improvement in net disposable real incomes, and borrowers won't be better off than they were before. Now, if at the same time asset prices go up, of course, that bails them out, and it certainly makes nice tabloid headlines. So one could say, so what's not to like? You know, a little bit of inflation, make it 4 or 5%, which creates this illusion of all of us getting richer, even though in fact we don't. The problem with inflation is the misallocation of capital. Because it's just so much more profitable to just buy and hold assets rather than to invest in productive assets and productive capacity. And as I said before, the social consequences, because if you're left out or left behind because you're not an asset owner, you will fall further and further behind, and that's detrimental, especially if interest rates remain below the rate of inflation. That means you're not even getting any help from the interest earnings on your savings to save your way up to be able to afford the deposit on your own home. So, and I think politically that bears a lot of risk. And we're seeing that in a number of countries where political parties, I think all of them are shifting to the left, could include the UK here, no matter what's said on the label, but they are leaning further and further to interventionist policies and of course to tax increases. So the next question then is, what about net disposable incomes after tax, and will they keep rising in line with borrowing costs if borrowing costs were to go up? hard to say at the moment. I mean, the good news is, so to say, unemployment is not seen as a big threat at the moment. In fact, as you know, unemployment has declined much quicker than we thought it would after the pandemic. So the combination of house price collapses, high interest rates, and unemployment is an unlikely scenario in the near to medium term.
Well, it seems for the time being, at least, wages are keeping up, even catching up. Richard, I mean, there is a positive aspect to this, isn't there? That, you know, people have. I mean, that's what caused the Brexit vote, arguably, in the end. That, you know, wages were depressed, but now it seems finally wages are catching up, which is a good thing, I suppose. So there is a positive spin to be had out of this, as long as inflation doesn't sort of escalate to sort of above 10% or something ridiculous like that.
Well, I talk about house price crashes being a generational thing. Bill, I think you and I are old enough to remember when inflation was double figures in the UK and the damage that caused. But actually, I'd like to kind of pick up on Jörg's point there about government becoming more left-wing, and actually Helen's point about more controls on affordability and lending and whatever. Fundamentally, for all house price inflation, this is still a very low-risk asset class. But when the more and more you have, well, one part of government giving banks an enormous amount of cheap, ultra cheap liquidity, and on the other hand, governments intervening to drive it away from things like asset, from houses, then we've got a massive misallocation of capital thing going on. And I'd be more concerned about the risk in the banking system of expansion to leveraged loans with covenant light, all of those kind of features, more and more high risk lending at lower and lower rates, rather than forcing it into the housing market, which would be rational. And another sort of related point to that is, we look at the asset classes that have been adversely affected by the economy, they're actually not very well correlated with risk weight. If you think about the risk weights of different sectors, according to the Bar Committee, according to the CRR, according to internal backward-looking models, riskiest categories, or I should say, the lowest risk categories like residential mortgages or commercial mortgages, or all those kind of things, are increasingly becoming high-risk high-risk asset classes looking forward. And I think we're getting a bit of a disconnect by relying on these kind of imposed from above views of capital risk allocation.
And you can expand on that. Even some parts of the infrastructure asset class has been badly affected. Think about airports, for example. So the infrastructure category, which also usually carries a high connotation of quality, is partly impaired too. Sorry, Richard, for adding that.
No, exactly my point.
So while we're talking about commercial real estate, I mean, Helene, how much does commercial real estate credit risk actually matter in covered bonds? I mean, we've seen a lot of, exactly. There's quite a lot of exposure in some of these deals, isn't there, to some of these empty hotels and street malls, which are only just starting to open up and so forth. Can you tell us about what your thoughts are about that?
Yeah, I think there is a misperception in cover bonds that mortgage cover bonds are always secured by, residential assets and private individuals owning their property. It's not the case in several markets, right? Germany has more commercial real estate than residential, or let's say they call residential, exposure, which are in fact multifamily housing, which is a kind of a bit of a different category animal. Danish pools have commercial real estate, Spanish pools so far. So it's prevalent in some markets more than others. And so it depends. I think the answer to generally commercial real estate we view as a more cyclical and more volatile asset class than housing loans. But the pandemic, there were trends which were there before the pandemic and which were amplified. I think you were mentioning retail. Obviously, we've all ordered online more because of the pandemic than was already the case before. So this is a trend which has been exacerbated by the crisis. The hotel sector, it was, you could have. I think they are slowly coming out of the wood, probably with. Depending on the location, obviously. So that's probably less of a worry. And offices is the next how do you call this, problem child, I suppose, in
Yeah.
commercial real estate, with the hybrid models, meaning that there's less demand potentially from tenants and more vacancies. So some adjustment will be necessary. One of my colleagues in CMBS was saying that having a central, location like in London, an office, headquarters in London or in some other capital cities was seen as a utility, was a must-have in the past, and now it looks like it's turning more into a luxury item that maybe you can afford not to have, right? So so certainly that's an interesting development which we are witnessing right now.
And Richard, how do you expect the commercial real estate exposures to permeate covered bonds, which are obviously structurally well protected?
They are well protected. I mean, Helen's absolutely right. Different sectors are performing differently, obviously. Some are doing well, some are doing bad. If you're an equity investor, that's great. Some go up, some go down. We're balanced. If you're a debt investor, it's not a symmetrical relationship. If you lent money to a logistics park used by Amazon and that's doubled in value, great. But it doesn't matter really from a debt point of view. The problem in a debt portfolio is always the downside, without the balance of the upside. Fundamentally, the covered bonds, I was going to say this covered bonds are incredibly well protected. They've got lots of safeguards. They're very, very safe. The German fan brief system, which has got the largest exposure to commercial real estate, has all these protections. But it can only go so far. And I suppose the correlation between the cover pool and the lender is an issue. If you have fan brief and it's locked away all these commercial real estate and it's great, it's got these protections, that's one thing. But if your balance sheet is fundamentally exposed to commercial real estate, your unsecured rating is going to start to go down. Now, do I believe that there's going to be a major problem? No, I don't at all. I think that the commercial real estate lenders in Germany are quite well capitalized and quite well protected from a downturn. Potential for it to create rating volatility and for investors to demand a spread differential between resi and commercial covered bonds because of rating volatility, absolutely. And if you look to our friends in the securitization market, they fundamentally factor in an RMBS, CMBS, resi mortgage, commercial mortgage differential that we've always ignored in our markets. I'm not sure if we start seeing AAAs going down to AAs, that's still sustainable, even though they're still perfectly safe.
And I mean, the pandemic has brought about a kind of a sweeping change vis-a-vis sort of the green agenda, the ESG agenda. Georg, I was wondering what your thoughts were about, maybe has it sort of accelerated change? There's changes that potentially would have happened anyway. In a sense, there's a kind of silver lining to it. I don't know.
In a way, there are silver linings to the pandemic. It has opened our eyes and been the catalyst for a number of discoveries and findings, not all of which are expensive or unhelpful. So when it comes to ESG, of course, it has reinforced the awareness that we have to do the right thing when we invest money. And lenders, investors are now even more looked at, scrutinized with respect to the prudence they apply when deploying their funds, and that prudence includes factoring in wider-ranging implications. And a simple example, which is not related to the pandemic, but of course, when it comes to funding bricks and mortar, and whether it's residential or whether it's commercial real estate, one would think that these days the due diligence carried out by the mortgage lender includes, of course, a thorough examination whether the buildings to be built or the existing ones to be financed meet state-of-the-art or market standards with respect to energy efficiency, for example. And therefore, I think, especially with respect to the latest or the upcoming climate change summit, I think we should all brace ourselves in a way. What we should in a way pull together and including those criteria, ESG criteria, in our investment standards, whether we are managing covered bond funds, whether we are rating them, or whether we are lending mortgages. We want to make sure that fresh money being deployed now should only be deployed to assets which, on the basis of current knowledge, have the best possible combination of properties with respect to environmental harm, but also the social good they provide, because obviously we do need affordable housing as well, and there is a bit of a trade-off between affordability and, say, climate efficiency, but we should work as hard as possible to find the optimum in that trade-off.
Absolutely, and there is some evidence already for, at least for commercial real estate, that the buildings that have high grade for energy performance, that they are faring better in terms of property values. So it's a differentiating factor as well, in that sense.
But on the risk side, Richard, do you see any potential risks for investing in ESG, whether that be in the form of sort of, I don't know, subsidies, or whether that be, in terms of the type of tenant that's going to be in there?
Potentially, yes. And I think we have to always think of the downsides. I think fundamentally there's two sides to the ESG investing debate. One is we want to allocate capital in a way that benefits society overall. That's a given. That's straight. We know that. And whether that's green or social, we can argue about the details. There's another element which is increasingly coming into the debate about the riskiness. Yeah, let's be completely selfish about our lending. By lending to green, am I taking more or am I taking less risk? There's a massive growing body of evidence, and then said about commercial, but it's, I think it's probably even a large body of evidence on the residential side. There's a correlation in energy efficiency and performance. Simply energy efficient mortgages default. Argue about the causation, the correlation, but it's fairly clearly empirically proven, and that needs to be reflected in risk rates. I think that applies to commercial mortgages, residential mortgages. But we probably do have to think bad thoughts as well. And it's clear that as the costs of some of the greening of some of the agenda become more of a political issue, there will be people who disagree. We saw in America, we saw an administration that was absolutely not buying into the agenda. It's got to be a non-zero chance that we're going to have governments in other countries in Western or Eastern Europe that say, well, maybe we're subsidizing this sector too much. Maybe people aren't so happy about that. And is it likely to happen? Probably not. Is it a non-zero? Yeah, absolutely. It's a non-zero risk that we're going to have a reversal of subsidies. So I think fundamental credit analysis needs to look at sensitivity to political decisions about where we go with green. It would be naive not to.
And let's move on now to the subject of sovereign risk, and kicking off with Helene. It doesn't feel like people are talking about sovereign risk anymore in Europe. It used to be a big deal, 9 years ago, obviously during the sovereign credit crisis, but it's cured. Why is that?
No, I can tell you my colleagues in sovereign have been very busy, and certainly they talk about sovereign risk quite a bit. So since the pandemic, they've changed ratings. So they've downgraded. I think they had 56 downgrades for 35 sovereigns since the beginning of the pandemic. Most of them in emerging markets. That's why it impacts us less in this covered bond market, I think. But still, there were some in developed markets as well, and there were sovereign defaults, Lebanon. So it's not like sovereign risk has gone away, absolutely not. And certainly they do recognize that public finance has taken a hit with deficit. I think there are 30% of sovereign, they said, which have a government debt to GDP ratio above 80%. So whereas pre-pandemic it was more something like 10%. So so it certainly is and Richard would say, Basel framework not pricing or not calculating risk weight correctly for sovereign. I agree, right? It's sometimes, especially the standard approach, is ignoring this aspect. So yes, they are. So sovereign remains a topic. I suppose it's less the domino effect. I think what you mean when you say there is less talk about sovereign risk is that there is less of the domino effect which we saw during the Eurozone sovereign crisis, where cover bond rating resisted well when banks rating were falling, but then they kind of followed suit when sovereign ratings also got downgraded, and there was this feedback loop between bank rating and sovereign rating, which due to the bail-in regime which we now have has been removed to some extent. So I think that's why there is less of an impact. But so certainly, so we've had some cover bond downgrades last year due to sovereign downgrades because of our country ceiling concept. And I think there is so less than 15% of our programs which would be impacted by a downgrade of the sovereign. So either because of this, they are rated above the sovereign already, and at some stage the country ceiling kicks in, or I mean, obviously not very likely, but in the public sector cover bond programs we rate, they are massively exposed to Germany. Germany being a AAA market, there is no issue. But if Germany's AAA was to be downgraded, and again there is no thing in sight, but it would have a repercussion on the public sector cover bonds. So it's not immune. Cover bonds rating is not immune against sovereign, but yes, I suppose in the Eurozone it's less of an immediate threat, and maybe something for the midterm, really.
And Richard, I mean, I guess part of the reason is also, due to the fact that we've had sort of the EU issuing a lot. To some extent, that's a fiscal transfer, isn't it? So one would guess if you're transferring between richer and poorer states in Europe, then along with the bail-in measures, that's kind of insulating against potential sovereign downgrades for some of the weaker nations. Having said that, there are some pretty horrendous numbers coming out there, from what I understand.
Yeah, I mean, if you have got a transfers from one country to another, is that a zero-sum game? If you improve the Southern European credit ratings, do you necessarily, if you're doing it by fiscal transfer, do you necessarily affect the northern countries? Now, on traditional ways of measuring sovereign credit, wow, debt to GDP ratios. And then just for your benefit, France, I think it's 120% debt to GDP ratio. The Maastricht, the Maastricht criteria rules where you're going to keep it down to 60%.
No, I suppose
any previous metric.
Yeah.
Wow.
Yeah.
It's off the scale.
Exactly. So it is, I suppose, it's a concern. It's at the top of the range, and certainly something our sovereign analysts are watching out for. I think, yes, on your topic earlier, Richard, of saying it's a zero-sum game. Hopefully not. I think that's a hope that because of the next EU generation next generation funds, that if the funds are used for a purpose that raise growth prospects for all of us, then in fact it doesn't have to be a zero-sum game. It can be net positive for for all countries. So I suppose that the jury is still out on this.
I'm interested that most of your downgrades have been in emerging markets, which, yes, there have, of course, been defaults as a result of what's happened, but many of the emerging markets are in so much stronger position to cope with increasing the rate cycle they were when we had the taper tantrum.
I think it's a general thing across credit spectrum. The most vulnerable are the lowest rated one, right? So and the lowest quality borrowers. So that's the same story. Even within residential loans, you could differentiate between non-conforming and prime borrowers, or between commercial real estate. We've discussed it. So same thing among sovereign. The one to be hit first are the lowest rated. So I think that's the logic there.
We talk about 120% and for France, debt to GDP ratio, but at the same time, we're sort of, we've got this green agenda which requires funding, I mean, presumably that means the goalposts are going to have to change, Georg. Do you not think that the EU could quite easily change their, from the political side, the 3% debt GDP ratio and a total debt of 60% is clearly out the window. Where do you think this is going?
Well, you said it already. I mean, these Maastricht criteria have basically been forgotten and confined to the dustbin of history. I just don't see them being mentioned anymore, and I don't see anybody seriously demanding a return to 60%. It's out of reach. No, these criteria were developed on the basis of certain assumptions. They were not picked out of thin air. The assumption at the time was, I think, something like 3% inflation or 2%, and then 3% nominal growth, or slightly different, and a certain rate of interest, because it was all about sustainability. Now, with the cost of funding much lower than the assumptions in the Maastricht model of sovereign debt sustainability, of course, you could argue that assuming that sovereigns in the EU can continue to borrow at these ultra low costs, it's perfectly sustainable to leave your debt at 100% or increase it to 100% or possibly even more. And Japan is a case in point anyway, even though some different conditions apply there as well. But sustainability is now doable, assuming interest rates stay where they are, and that brings us back in a way to the ECB point. The ECB point would pull the rug underneath those assumptions if they were to fight inflation in the way other central banks would have done in the past. So yes, we coming now to infrastructure or climate-friendly changing investments. Yes, we have popular support for that. The public is not really that worried anymore, certainly not in the EU, in the UK, about government debt continuing to rise. I think most people wouldn't even know that the UK is now, as far as I know, above 100% as well. And therefore there would be acceptance for even more debt if it's for the good cause of making the planet a better place. The problem I see is we just don't have the physical resources to implement all these investments. We may be able to print the money. We certainly are able to print the money, but we just don't have the workers, the builders. We don't have the material to do it. It's evident in pretty much all walks of life at the moment that the limits to growth at the moment is the resources, the physical resources, both human as well as material resources. So therefore, if the EU and EU governments really start spending money on laudable projects, whatever they are, to improve energy efficiency and insulation, they would hit a wall, and the wall being the ever-rising prices for the services they would need to employ to get these investments carried out. And then inflation really will become a serious issue, which then probably can't be swept under the carpet anymore by all sorts of euphemisms. So that is, to me, the biggest constraint now. It's no longer Maastricht ratios. It is no longer any public concerns about a sovereign default. The public kind of has lost interest in that, but there just isn't enough. There aren't enough physical resources to implement these grand schemes, and that's the biggest problem anybody faces at the moment who wants to build a house, who wants to refurbish something. Even if we want to do Christmas shopping, we might be told, look, it's no longer there. But one point which I thought is maybe worth making on sovereign debt quality, I think we have, I mentioned earlier, the growing divide within this society between, say, asset owners and asset borrowers or renters, but we have a growing divide globally as well as in terms of sovereign credit quality. Look at Latin America, which is, in my view, going downhill, and states are collapsing there. compared to where Latin America was 20, 30 years ago. It's a really sad story, and parts of Africa, South Africa being maybe one of them, have seen their ratings decline, have seen their growth declining. So there is growing divide within the emerging markets spectrum, as well as between emerging markets and the rest of the world in terms of credit quality, which is a big concern because we have migration being a growing theme, at least, and the rise.
We're running out of time, George. We're running out of time, Georg.
Cost is not going to benefit all emerging markets. So that was my final point.
Thanks very much, Georg. We've actually got less than a minute to go to the end of the panel, and we've kind of run out of time. And I wanted to talk about relative value, but Helene or Richard, will the new credit environment change relative value? Richard, any thoughts?
Fundamentally, yes. I mean, part of the reason that I would answer a theme we haven't discussed in the sovereign debate is we have reduced the linkage between covered bonds and government credit, and that has to be reflected in a different approach to relative value constructs. In particular, that the best Southern European national champions should massively underperform and not be penalised, for example, just because they happen to be based in Spain or Italy.
Yeah. So does that mean that sort of a strong Spanish bank could trade more closely to a weak German bank, for example?
Or through.
Oh, wow. Okay. Helene, any thoughts?
But certainly there was the hope of the European Commission with the harmonization of covered bond regime that that if it was a perception issue that some frameworks were stronger than others, that this should go away. I'm not sure harmonization will achieve that goal, but yes, we'll see.
Well, that brings us to a conclusion of this panel. We're already overdue on time. Thank you very much to all our panelists. And next up is Richard, who will be giving the closing remarks to the conference. Thank you very much.
Thank you.
Bye.